An LLC stands for Limited Liability Company. An LLC offers business owners liability protection that is comparable to a corporation, but is taxed more like a partnership or proprietorship. An LLC owner's personal assets are filed separately from business liabilities, debts, and other such expenses, but the income is seen as the same. Proprietorship is the structure of a business so that it is run by a single individual with no distinction between the individual and the business. Another aspect to look at along with the liability and debt is that the business owner is separate from the business so as not to be caught up in a lawsuit if the lawsuit is aimed at the business and not the owner personally. An example would be, let's say you own an LLC and you get into some legal trouble and the business is sued. The business's assets are up for collateral and the case of the lawsuit goes down negatively. And if you lose, you would have to sell business assets such as maybe some land that is under the business or the company vehicles. However, your, the owner's, personal vehicles and house are not part of the sellable assets because they belong to the owner, not the business, that is the LLC. There are two major kinds of LLC. The first is a single member LLC and it is classified as a disregarded entity by the IRS. The reason is because this LLC is treated as a sole proprietorship for income tax purposes. With a single member LLC, the profits and losses are directly reported on the business owner's personal tax return. That form is usually a Schedule C 1040 form. With this structure, the LLC, aka the business, does not file separate federal income tax returns because the income is reported on the business owner's federal taxes. The business owner does have to pay self employment taxes to cover Social Security and Medicare for the net profit of the business. When you are an employee, these taxes are taken out of your paycheck by the employer. But for an LLC, the business owner is responsible to cover the cost and pay for them, such as a private contractor would do, because the owner and the business are seen as the same income. As a single member LLC, the owner has full control over the decisions related to how the business is run and what financial decisions are best. The second kind of LLC is a multi member LLC. This LLC is taxed as a partnership, hence, it has the prefix multi in the name. This is a company that has many members and therefore many business owners, aka partners. The method of taxation for a multi member is using the pass through method. The pass through method breaks up the business's taxes with the members who are the owners of the LLC. That means that each member pays income tax on their share of the business profits that corresponds to their share, and they report it on their own personal taxes, which holds the percentage at their personal tax bracket. The LLC company files an informal return called Form 1065 to the IRS. This form reports all profit and loss of the business. Additionally, each member will receive a Schedule K1 from the LLC pertaining to details of the business related to filing, such as the individual's share of the deductions, income, and credit through their share of the business. Each member then files his reported income on their personal tax returns called a 1040. They each pay the amount of self-employment tax for their personal tax bracket with the income that they receive from the business. They each also have to pay self-employment taxes to cover Social Security and Medicare. However, same as the single member LLC, each of the multi-member LLC owners have personal asset protection with the correct legal paperwork put in order. That means if the business goes into debt or is sued, the owners, aka the members, personal assets such as their houses or cars are protected from the business. Now with that we have the two categories of the LLC covered, let's discuss something that can be filed for both options. Both single member and multi member LLCs can file as a C corporation or an S corporation. When an LLC elects to be taxed as a C corporation, they file a form called an 8832. That makes the filing of taxes very different from the basic layout of an LLC. Form 8832 makes it so that now there is double taxation. The business is taxed as a separate entity and files an 1120 form instead of being passed through to the owners of the business. The company's profits are going to be taxed at a corporate level instead of a personal income level. The reason it is double taxation is because the owners can be paid in the remaining profits in the form of dividends, and the owners will now pay taxes on their personal income received from the dividends. essentially paying for both the business income and their own income on their federal state instead of having it grouped together. Additionally, the owners cannot use business write offs for their personal taxes because they are seen as separate entities. You may be asking, why would anyone do this? Well, this is generally used for higher paying businesses. When a person makes a certain amount of money, they pay taxes according to the tax bracket they fall in, but there is a flat rate for taxation for a C corporation. Let's say an LLC with a single member LLC layout made 700,000 in net profit. Now remember, this income is passed to the owner, so therefore for tax purposes, the owner makes 700,000 and that would fall in the tax bracket of 37% in 2025. That means that the owner owes 259,000 in federal taxes. We are not looking at the self-employment tax right now, which adds more payments. Now, as a C corporation, that 700,000 would be federally taxed at the 21% for a C corporation rate, and that would be 147,000, not to mention less because the dividends that would be paid out to the owners. So as a single member LLC, 259,000 would be owed, and as a single member LLC C corporation, 147,000 would be owed. This is the simplified example because we did not go over the dividends, self-employment taxes, and deductions. The point is that when an LLC makes a lot of money, filing as a C corporation helps offset the taxes when organized properly. Now, an S corporation makes so that the owners/members are seen as salary holders for taxation purposes, but also brings in a version of the pass-through method back into the mix. The LLC first files an 8832 form so as to be taxed as a corporation, then files a 2553 form to elect to be called an S corporation status. This path is used to help reduce self-employment taxes and avoid double taxation due to the fact that the income and losses will continue to pass through to the owners/members. The owners/members of the business are paid a salary on which they pay federal taxes, and the remaining income to the business is distributed as dividends back to the owners/members, but the distributions are not subject to self-employment tax. This is accomplished by the fact that as a single or multi-member LLC, the owner/members are the sole profit subjects. But with an S corporation, the owners/members are seen as employees given a salary, and the extra profit is not in the salary, is seen as distributions and is not subject to federal tax. An example would be if an LLC single member made 100,000 in profit, then all 100,000 is subject to self-employment tax, which in 2025 is 15.3% roughly. Therefore, 15,300 in federal taxes is owed. Now, an LLC single member filed as an S corporation makes 100,000 in profit, but paid 60,000 in salary to the owners and then 40,000 in distribution. The 60,000 in salary would have the self-employment tax of 15.3%, but the 40,000 would be free from self-employment tax, therefore saving what is paid to the IRS. Again, this is a simplified example just to show the idea of the difference between the two. The simplest way to say it is that an S corporation LLC keeps the pass-through effect of the business not having to pay federal taxes on income, and it passes through to the owner, while a C corporation LLC is treated as its own entity and is federally taxed on both the business's income and the owner's income. To wrap it all up, remember that federal taxes and self-employment taxes are not the only payments. There are many others in addition. Be sure to check the state that the LLC will be registered from. The state may charge an annual fee for franchising tax or the ability to run an LLC out of the state. Also, there may be sales tax involved, so be sure to check your state rules and regulations. If you want a more in-depth video of any of these subjects concerning an LLC, please leave a comment down below. Thank you for joining me in this excursion into the world of LLC. Bye.